Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to talk about a bunch of different questions in the comment section. Sometimes I go through and look at the comment section. These are very similar to what a platinum question and answer session would be like on the website. I'd answer every single question that people have, give my opinions on it, financial opinions. And I'll do this. I do the same thing roughly here. I just don't go over individual companies like I do in the question and answer session, and why I'm choosing some of the companies, which ones I'm really overweighting. Which, if you've been with the website for a while, you know which ones I'm overweight. You know they're performing pretty well, at least the ones that are overweighted. And I'm really trying to down select the risk reward for everyone, for myself and for everyone. Let's dive in, give you my financial opinions on some of the questions that I see in the comment section, and I'll give you my opinions around them. So this person says, out of gold, silver, and platinum based on ratios, I'm only buying platinum. That is correct. Platinum and silver are the two cheapest on a ratio perspective. So if I were to yank up something like a platinum to silver ratio is what I'll do. So here's platinum to silver. This is the ratio there. We're basically in a gigantic falling wedge. We've broken that wedge to the upside here, and we are still at a very low level. So what we're doing is we're waiting for the market conditions to change where this ratio reverts to the mean or reverts to an overvalued state. Now, last time that reversion happened, it happened during the beginning of a commodity bull market. From 98, it kind of went sideways here, and then we ripped it in 99, and then ultimately peaked in the ratio in 2003. Now this time, we've got the falling wedge, the 1, the 2, and then possibly the 3. This here was a topping pattern, Batman pattern. Before that, and we've got a wedge that we've basically broken to the upside. Will this move immediately? I don't know that answer. That is what makes it difficult. We know platinum's cheap to silver with 100% certainty given where it's at. Now, it doesn't mean it can't get cheaper, but we're at a very cheap level, and anything in the 30s, I would say, is a very cheap area to be looking at platinum against silver. Platinum's also cheap against all the other metals. I'm just picking on silver at this moment. And this will eventually work its way up. The timing is unknown. So that it sure looks good. We have broken out of the downtrend, and this could happen at any time. Silver can also go up. Silver is another one that is also very cheap. So if you look at silver divided by, this is going to be palladium. You can see silver basically bottomed in 01. It's bottoming again and turning higher against palladium. Palladium peaked in terms of how undervalued it was right here in 2009. Palladium works very well in a recovery phase. That's when you want to be invested in it. You want to swap your metal to silver or platinum or some other metal. And now we're working our way back up with the ratio. So looking at what is a good investment, silver is still good. I have a portion of my money allocated to silver and allocated to platinum in the physical metals because of where both silver and platinum are in a ratio perspective. I think they are both in a very good location. Someone says, what will be the next bull market or bull sector after commodities? So what generally happens with commodities is you're going to get this Fed funds rate. All right, here's the Fed funds rate. Commodities generally do very well when the Fed funds rate is increasing. You're under an inflationary condition. When this thing comes up, generally speaking, commodities outperform. That's where we want to be. It's coming up, and we're still going up in interest rates and the Fed funds rate. When it pauses, like at the top of '07, and if it pauses sometime at some point, that's when you got to look for topping patterns eventually in energy and other commodities. I think we're still early, and we might get, it may even, I have to see if we kick back on the housing starts. That's what we're really looking at. Because if we get a movement in interest rates where it comes back down, much like the 1970s, it came back down and kicked on the housing starts again because of the demographic, we could still have further upside for commodities. But nonetheless, when this goes sideways, the Fed funds rate, and they're not hiking rates anymore, we need to watch to see what the markets look like and what the housing starts are doing. If we get a peak and it starts to go back down, that's where you want to jump into bonds. So if I were to put bonds up here and put a new pane, when this thing starts to roll over, so it's a little bit after, you want to jump into bonds down here and sell your bonds at the bottom here. So that's the ride up you want. Commodities do well under this phase there. So we want to go into bonds. Bonds are going to go up at that point when we get to that part of the cycle, and if there is a potential crash and they lower interest rates. So bonds would go up. That'd be a good spot. And then after bonds, depending on what the Federal Reserve does, if they react and they print money, actually, I'll put bonds back up there, and then I'll put gold up there too. We sell. We can as they go up and then they lower it. We can buy bonds here. We can come and we can sell our bonds. We can rotate into gold if they do stimulus here. Ride gold up all the way to the peak here, and then you can go into technology stocks in 2011, 2012. That is the cycle that I would probably do. So it would be bonds here, sell your bonds when they hit the low point, which is basically here. You buy gold, you ride gold up, and then what you want to do is I'll just throw I'll just throw in MasterCard, all right? I didn't mean to put it up there. I meant to put it down below. Here, Fed funds rate. I'm going to do this one first. Fed funds is up the top. Get MasterCard out of there. And then we'll put MasterCard. I'm just going to give MasterCard a spin here, guys. So then you're up there, and then you buy MasterCard here and ride MasterCard on up. So that's basically your cycle. And then before that, if I were to put oil, just to show you guys a crescendo. Oh man, I can't believe I put it up here. 1 second, guys. I want to put that underneath. New pane. This is what we're riding back here. So as the Fed funds rate basically peaks, we're going to ride our oil up. We're going to do a transition in here into bonds, because this is where your risk starts going up. This had a blow off top. You're going to miss some of that blow off top because we want to start to position for the decline in the interest rate. So there's your big move up in oil. You would have gone from about $10 all the way up to something like 80 or something like that, 80, 90 dollars. You swap in here to your bonds. You sell your bonds, swap back into gold, ride your gold up to the peak here because the stimulus that was created, swap it back into technology stocks or regular stocks, and then ride your stock market all the way up. That is essentially what it is. And you're always working your way up each time as you go. So that's the general rule of thumb of how we were going to position in this. And, keep in mind, at some points in this market, the market's going to get very risky. No one's going to nail this top to bottom. But there's going to be times in the market where things become extra risky, and we don't want to keep pushing our luck in, say, a commodity that could roll over and crash. So at some point, we're going to move and shift money into bonds for the deleveraging event in the housing market. And if the housing market doesn't have a deleveraging event, what is a deleveraging event? Let me explain it, guys. That is credit being destroyed in the system. That's a deleveraging event. So the leverage in the system is coming back down. It's foreclosures. It's credit being destroyed, bankruptcies. That's what the part of the cycle is if it's a deleveraging cycle. The long duration bonds, TLT is the ticker symbol. That is what's going to go up during that type of market condition. You're going to be getting paid a pretty hefty dividend on them. I think they pay them monthly. You're going to be getting a big dividend, boom, 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 boom. And then that is when we swap into that. Now, if the housing market, if it starts to tank, we may need to swap over to bonds earlier. If the housing market's resilient, continues to track higher, and we get no sort of topping patterns in oil, ride the energy train. The energy train will be good all the way up till a potential crash, because that's a late cycle performer. So that's kind of the sequence of events, looking at it backwards of what I would do. So bonds and then tech. Yep, bonds or gold, then tech is probably what I would do. Moving on down, energy, X, and drills will rule in the near term. Explorers and drillers. Definitely agree with that. Totally. The Canadian government's pissed because Suncor CEO stated they were focusing back on their core business, which is oil production. I don't know how we can get away from oil production. We can't. Transportation's about 25% of oil production. So even if you were to dramatically decline transportation, you're only declining 25% of its uses for oil. And that's where I get a little bit confused on how certain countries that are wealthier are going to, basically slow down the adoption of ICE or hybrid vehicles, try to go to electric. And here's the kicker, guys. That their number one plan here, their number one plan is to get everybody onto electric vehicles. So if we run into problems adopting electric vehicles, which I think we will, it's going to be a mineral constraint problem. What do you think people are going to do? They're going to say, I'm going to go buy an internal combustion engine car or hybrid. That runs on gas. So if their plan A fails, their backup plan is nothing. It's basically burn more oil. Now, what if we did not invest in oil production on the supply side, and your demand rips up because they fail to make as many electric vehicles as they think they can make? Well, I see more upside to oil than what most people think, because I don't think that electric vehicles can be adopted in the quantities that they think they can adopt. Neither does Toyota, and neither do a lot of these large manufacturers of cars. They think that they're going to hit mineral constraints, and that's why they're building hybrids. Now, if they're building hybrids and the adoption of more cars in India and China and all these ones that are in the middle of their S-curve, their energy curve adoption rates, guys, we're going to be burning a lot more oil for a lot longer. I think these estimates could be wrong. And that's why I'm very much an oil bull for a pretty long period of time, because I think it's all messed up. But we would still see a pullback in that scenario if we lose the housing starts, the volume of home loans against new homes. If that starts to decline and we get a deleveraging type of event, which I don't think we will, at least not in the short term, that is what is going to bring down everything. So that's what we've got there. Please consider doing a show on the most undervalued commodity on Earth, according to geologists, silver, aka physical silver. Well, the most undervalued is, you can define it from multiple ways. Silver could be because it's the number 2 commodity in the world in terms of its uses. Platinum is cheaper than silver from a monetary standpoint compared to history. Another commodity that's cheaper than silver is natural gas. So if we were to price silver divided by natural gas, what you're going to see is you're going to see that nat gas is one of the cheapest times in history that we're actually at. So silver is cheap when you're down here. Silver was cheap in these areas here. Nat gas is cheaper up here. So silver is not the cheapest from a historical basis from comparing it to history and the current valuations. Silver is the cheapest, perhaps, arguably, given for the utility that it brings to society. So that is what I'll say. And I still think that it is good to have exposure to many things instead of just one or two commodities. I like taking a basket of what's cheap out there. You could say natural gas is cheap, oil's cheap, uranium's cheap, silver and platinum are cheap, and you can create a basket, a portfolio of very cheap, undervalued assets. And if you put enough money in each of them, you only need a few to really work, and then you make a boatload of money. I think the problem is everyone thinks that a person can be right 100% of the time on all of their companies, all of their sectors, and nail the timing on everything. I don't think that's possible. I think what you need to do is you find 4, 5, 6 different sectors that are incredibly cheap. They're looking like they're inflecting positive. You put money into them or allocate money to them, and then you ride that move. Some may take off immediately. Some may lag or give you a false signal that they're going to break out. You still have an undervalued asset. It's just not breaking immediately. It might take some time. So that's why we kind of diversify out a little bit and buy a group of undervalued sectors. The best thing that you can do for physical metals, because I know you're talking probably physical silver here, the best thing you can do is to buy under the cost curves at all times. That will ensure that at some point they have to go higher. Now, there is a battle between, you've got a battle between depletion of a physical metal. We'll call that depletion of a mine. The ore grades start to decline as we go after higher and higher cost mines. If that's the case, at some point when we start to deplete a lot of the mines, the costs will go up and your cost curves could go up. But at the same time, technology is trying to bring those cost curves down to more efficiently suck whatever metal it is out of the ground. So you're fighting against technological improvement versus the ore grade declines. And that's what an investor should be looking at. And that is also paired against how much money is being created in the system against the metal that's being brought out of the ground. It's that dynamic right there. Uranium hands down, yeah, definitely. Really like oil and uranium, specifically offshore services and uranium developers. Too hard to basically just pick one. Definitely. I'm in a wide variety of commodity stocks. If it drops, I buy. If it goes up, I trim. Next year will be amazing. Yeah, it will be. Hopefully. So another good strategy is to basically buy as much houses as possible and be a real estate lord over these years versus buying commodities. That could work too, right? So what you want to do is, if you're looking to buy real estate, you want to buy that towards the beginning of the real estate cycle at a recovery phase. So you get a big recession, it comes back. There's a couple of years there where we overbuilt. We get a deleveraging type of, well, fingers crossed, you get a deleveraging type of event. It may not be deleveraging. They might have just built too many homes and you get a small slowdown. 2008, they had a bunch of bad loans. They were foreclosed on, bankruptcies, and then it crashed. That would have been the best time to buy because you've got foreclosures that banks owned that you could basically undercut them quite a bit. And they're like, here, just get it off our books, take it. So that's when you'd want to buy is 09, 2010, 2011, in that time frame. That's where they had peak foreclosures, peak bank-owned stuff, and that's where a lot of them came on, was that '09 to 2012 region. Once those foreclosures dried up, once the inventory started to dry up, we started to move our way on up in the mid 2010s and late 2010s. So I don't know if now would be the best time to acquire as much real estate as possible, because we could be coming into a peak, a peak couple of years out in the future, and I would have done it in probably 2011 would have been the best year to do that. Commodities right now are what are in cycle. They are incredibly cheap. So I am playing the commodity spot more so than the real estate. But in real estate, you can get a fixed rate loan, and there is leverage to it. So it's up to you on how you want to do it. Real estate to gold ratio. Any comments? And I know that that's pretty cheap. I'll look at this. Real estate to gold ratio, and on long-term trends, they've got this 132-year chart. This is the 132-year long chart. Let me squeeze it up a little bit here. Let me see if I can just yank this over a little bit. So this is the entire chart here. We are very cheap in this real estate to gold ratio. It was very expensive in 1971. 1980 was very cheap with high interest rates. I do think this is going to go lower. As weird as that sounds, guys, I think it's going to go lower, where gold is going to outperform real estate. The reason I think it's going to outperform real estate is because of the market conditions. It's going to be a shortage in real estate. I know that sounds weird, but there's also going to be lower production of gold, and I think gold's going to outperform real estate in this at the end of this cycle. Then real estate is going to be priced differently when it crashes. So I mean that's my take on it. Could you verify the fractal by going back in time, like 1970, comparing it with the bull market that was right after? Might be interesting to see if the fractal matches it or not. I don't know if he's talking about crude oil. We can grab crude oil if it goes back that far. I don't know if it does. That's there. Let's go crude oil. So here's U.S. oil. Let's see if that goes back. Okay, so this goes back all the way to the 70s. I'm going to grab this, put it as a line chart, and then I'm going to copy the fractal here. So here's the fractal out to 81. There's the peak. This is basically the fractal. If I were to overlay it, that's what it looks like here over the last bull market, just to show you guys. And then if we were to look at it from this perspective here, we can grab this, and what I think is going to happen is that we never really had a pullback in crude oil in the 70s, but it's probably going to be something like that. $448 is probably that fractal, and where it went sideways here is the pullback. That could potentially be the case depending on how much money is created. If I were to grab this fractal here and overlay it, one could say that it's over like $500. Another person could say, well, no. It's actually something that looks like this, and I don't know. It doesn't really match very well that way. So there's different things that we can do. I think if we can heat up and get above $133, we could continue higher. What is going to determine this? It's basically the supply side being constrained and the credit side going unabated. So what happens is it's credit that is expanding faster than supply can be brought online. And that is how we get in these situations. Credit expands at a faster rate than the supply can. So this is your real estate loans. And your real estate loans, auto fit it. There we go. What happened is the real estate loans from 99, we had basically a supply problem, and you could see the loans grew really fast. This is your crash. The peak was in 08, 09 for the loans in the system. The crash occurred in 2008. So the crash occurred right here, basically. And you could see the crash in the loans. So that is what drove that. It's this credit in the system outpacing all of the commodities. And that's what causes this shift in money. Now, we also have a very similar action here. We had a very big up move in the real estate loans. This year went sideways due to stuff shutting down, the COVID shutdowns. So the steepness of this curve going here is what is giving us the imbalance in the market. It is credit being created at a faster pace than supply of commodities or GDP. You could also compare this to GDP, gross domestic product, and then what you get is when you get these big moves upward, that is where you can get the problem if there is a supply constraint in the commodity. We could see that here. We had a massive move up in loaning from 96 all the way to the peak of 2009. And that is what really shot that up. We could see another big, large spike here that occurred in 2020. But they've walked that thing back as much as they can. So that's that for that. Scrolling on down, we're already at 26 minutes here, guys. So I'm going to end it there. Those are some things that I look at. Those are some of the things that I answer are questions like this, much like the website. The one thing I do go into is individual companies, and there's really just awesome setups out there right now. Energy Service has some really good setups. There will be a very good setup, I think, in precious metals at some point. They do have falling wedges and stuff like that. I do think it's going to be soon. But right now, we just haven't seen the physical metals take off yet to really lend the gold and silver miners to move. We haven't broken the downtrend yet. We're getting close, and it will come. So that will be a next one to look at. Physical metals and some of these gold and silver mining companies. If we can get a break, I'm going to really beef up that portion of the portfolio when that does break. All right, guys, thumb up for the content, subscribe to the channel, subscribe to the website. We do have that 50% off September coupon code if you'd like to join. Love to have you part of the community. You can ask me whatever questions. If you want, check out the website. Shoot me a contact message if you guys have any questions about anything. All right, guys, we'll catch you later. This is Finding Value.